Hi, it's Lee and welcome to the Tech Economist. In our last video, we recently tried for a believable production rate for 2023. I don't think anyone disagreed it was a very believable rate for the next year. I mean, a believable minimum. I think that if Tesla did achieve this rate, they would struggle to get 50% growth in 2024. So in that sense, it may not be believable. But no one suddenly thought I was being too bullish or a delusional fanboy with hopes and dreams. Tesla are going to keep increasing production through the entire recession, at least as far as what I inferred on the earnings call. It's much easier to gain market share in a recession when everyone else is cutting back and you're still profitable enough to keep growing at 50%. This is not the time to cut back production. Even if it means Tesla reduce their margins somewhat, it's just temporary. People get too distracted with Tesla and they focus on one area and ignore others. And whilst we see them going one step back when it comes to something like ramping the new factories, FSD, or 4680 delays, and all eyes are looking into that direction, Tesla end up taking two steps forward with something else, like increased production 30% in Shanghai, which I infer to mean all their factories potentially have 30% more output than we were led to believe. Put it this way, I don't think any of us will be too shocked if Berlin or Texas end up at 1 million Model Ys a year run rate in just a couple of years. This bearish model we created had production at 2.3 million and came to a PE ratio of 19 at the end of 2023, which more than anything I wanted was just an indicative number to illustrate my point that I feel the stock price is suppressed too far and lost perspective. In 2022, Tesla's earnings are going to be around $14 billion for the year. In our estimate we just did, the earnings came in at $32 billion for 2023. This was a 66% increase in production year over year. Yes, slightly above the targeted 50%, so you might wonder how this was meant to be a conservative estimate and not bullish. That's because Tesla's end of the year run rate will already be at a 50% increase in production at the end of Q4 this year. It's not that I've increased 2023 production unrealistically, it's that we had some bad quarters in 2022 where we lost some production, deliveries, and profits. Now, $32 billion means that earnings have increased $18 billion year over year, which is a 130% increase, despite only 66% increase in production. Earnings increased almost twice as much as production, and this is what I keep trying to explain, Tesla's outstanding operating leverage. That when the economies of scale kick in, OPEX per vehicle will reduce further, meaning higher operating margins within the company. In addition to that, this year had Tesla's two biggest assets counting against them, Giga Berlin and Giga Texas. Some quarters, they not only pulled down gross margins, but actually created losses and took away from profits, thus meaning that once ramped up next year, they will start contributing significantly to profits and raising the gross margin. Now, when I did the 2023 numbers, I was continually saying that this was meant to be believable. I even included a random incident in Q3 that resulted in lost production of about 30,000 units in one quarter. I didn't even take Shanghai close to its new capacity throughout any of the quarters, nor the new capacity that we're expecting from Fremont, possibly when 200 Tesla Shanghai employees help upgrade that facility. Now I'm going to do a more bullish model, but again, this is not for hope either, more to illustrate, again, how much higher the earnings will increase once production is up. In reality, if you see this and think something like, these numbers are ridiculous, what a useless model, it's moot, as instead of thinking this may occur in 2023, perhaps if it doesn't go as well as this, then it may just mean Tesla reach this level of production mid-2024 instead. So rather than thinking these numbers are useless and unbelievable for 2023, then they should inevitably occur one day, even if it may be 6 months later. Assuming the number is good, and you think the stock should be worth perhaps $500 or something, then whether it's at the end of 2023 or mid-2024, it's not a huge discrepancy, and still a great return on investment either way. And at the end of the day, that is first principles thinking as investors. What return do I get and when? If you're doubling your money every 7 years or so, that's not bad. But most Tesla investors seem to think the stock price will probably do that in less than the next 2 years, which is exponentially better. Our last model was extra bearish. I hadn't even included subsidies and I hadn't raised the prices to compensate for the tax credits in the US. Also, I had Cybertruck production behind schedule. So let's do this model to try and be more realistic in some regards and a bit more bullish in others. The last estimate also ended Q4 with an annual production rate of just 2.7 million, whereas I would expect or hope them to be closer to 3 million by the end of the year. Of course, all dependent on when the 4680 production line really kicks in. We'll also have smooth sailing all year and not factor in events like lockdowns. So let's begin. In the first quarter, I'm increasing Fremont slightly from our previous numbers. However, I'm also ramping up Berlin to 60,000. Elon said it was meant to hit volume production at the end of this year. Then he changed that to the start of next, which is 5,000 a week. And about 13 weeks and a quarter would come to 65,000 in total. And that would be without any further ramping. So 60,000 seems reasonable. Despite this being bullish, I think I still want to maintain the theme of believable with justification. In fact, this is probably closer to what I do expect, and definitely closer to what Elon is implying. Then Texas will average 3,500 a week, or 45,000 for the quarter. And I'm just going to keep Shanghai at around the same rate we saw in October, and I'll just slowly increase that factory over the quarters. For Q2, we will increase Fremont again. Remember, we heard Fremont's next goal is 14,000 a week, or about 182,000 a quarter. Our estimates are still behind, and we'll increase the rest of the factories accordingly. Same for Q3, I'm just going to increase them gradually. Nothing over the top really, in my opinion. We saw a bigger ramp in Shanghai at much earlier stages when they were building their Model Y factory, so this is still believable and possible. And for Q3, we will add 10,000 Cybertrucks, an average of 750 a week. For Q4, Elon says we should be at 5,000 Cybertrucks a week by the end of Q4, so averaging 2,000 a week for that quarter may be a possibility at around 25,000 total. The new Model Y factories are put around 100,000 a quarter, still under the claimed capacities. Adding in the rest, we hit 700,000 for Q4. Now, Tesla are meant to be at a run rate of over 500,000 towards the end of this Q4, so this would in fact be a 40% higher run rate than that over the whole year. Annualizing that Q4 comes to 2.8 million run rate, and I've been saying that I expect Tesla to be at a run rate of nearly 3 million by the end of 2023, so that probably is getting quite close. The total production is around 2.5 million for 2023. Now we add in the ASPs. In this scenario, I'm going to increase Texas and Fremont ASPs slightly due to the tax credit. We'll leave the rest as they were and not factor in the potential likelihood of the US dollar weakening. And we get a $55,000 ASP. And then when we add in FSD, we're now at $140 billion revenue. I'm increasing Fremont margins slightly due to these price rises, and Texas too, giving us an overall margin of 33%. If this sounds high, then bear in mind the factories that were pulling margins down before are now going to be pushing them up, generating a gross profit of $45 billion, $5 billion higher than our bear case. And I know some of you will likely say something about China, but worst case scenario, I think Tesla could be able to export about 2/3 of the China production, possibly even more. So Tesla will simply move the supply to where the demand is, meaning China could be a relatively small market for 2023. I'll leave all the other figures as they were in the last, as I'm fairly happy with them, and they don't make too much difference, with the exception of one. We now have subsidies to add too. If Tesla gets $45 per cell and battery produced, then perhaps about 40 gigawatt hours from Giga Nevada. Yes, Tesla receives subsidies there, even though it's Panasonic's production. Elon had the foresight to include that in the contract. Then that's $1.8 billion just from there. And with 290,000 Texas Model Ys, let's say 250,000 are with 4680 cells, that's about 20 gigawatt hours as well. And 35,000 Cybertrucks, maybe another 4 gigawatt hours, which is about another $1 billion. And probably some for energy storage too. I think for the battery assembly, but not the cell assembly. So let's take that to $3 billion in subsidies to come to. We could add semi-trucks in there as well, perhaps, but that only might be a couple of $100 million or so. But it's too hard to guess at this stage, really. Total gross profit is now $52 billion, and net income hits $38 billion instead of $31 billion, around 22% higher, so not too far from our bear model. Then when we look at the current market valuation, we see that this would be a PE ratio of 16, at least at the end of 2023, and probably more like 12 or 13 relative to the Q4. It's getting ridiculous, almost laughable really. Of course, this did assume smooth sailing for the year, which we can't necessarily count on. But like I said at the start, even if this is not achieved by the end of 2023, then you might think Q1 or Q2 2024 might hit around 700,000 deliveries instead, and we're in the same scenario. Even in this economy, I put a PE ratio of 30 in there for the Tesla. In fact, currently it's 60 based on the trailing 12 months, which is only $11 billion in earnings. We're now suggesting potentially $38 billion, over 3 times as much. Do you see how irrelevant a trailing 12-month PE ratio is for Tesla? Anyway, if it was a PE ratio of 30, then we'd likely be around stock price about $380, which I have to say does sound pretty good in these times. But 30 probably is a bit low for PE ratio, given it's twice that now, and in a recovering economy will likely be more comfortable around 40 to 50. I'm not really sure that there'll be that much that actually help the stock get close to $400 in the meantime, at least in this economy. I think we have to wait this out until we're around 700,000 deliveries a quarter. The important thing is, though, there is a path to get there, and it has been clearly outlined. Of course, as usual, all bets are off if Tesla crack robotaxis. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.